Did you know that more than 70% of Americans are living paycheck to paycheck? That's a shocking statistic. In a world where investing has never been more accessible, why do so many people struggle to build wealth? The truth is, many fall into common traps that prevent them from making smart financial choices. Here's another eye-opener. According to a study by the National Bureau of Economic Research, only 15% of people consistently stick to their investment plans. This means the majority of investors often make emotional decisions, leading to losses instead of gains. Why does this happen? It's all about mindset and strategy. In this video, we'll uncover the hidden reasons why most people fail to achieve financial success. We'll explore the dangers of chasing quick riches, the impact of emotions on investment decisions, and the importance of patience in building wealth. By the end, you'll have practical strategies to change your approach to investing. So, if you're ready to break free from the cycle of financial struggle and learn how to think like a successful investor, stick around. This journey to wealth building starts now. Chapter 1. The Illusion of Wealth. Why get rich quick is a trap. Let's face it, the dream of getting rich quickly is everywhere. We see headlines about people making millions overnight with the latest hot stock, crypto, or startup. And it's tempting. But for every success story, there are hundreds, even thousands, of losses that we never hear about. The reality? The majority of investors lose money when they chase quick gains. In fact, studies show that 70% of retail traders lose money trying to time the market. Barber and Odine, 2000. One of the most famous value investors, Warren Buffett, once said, "The stock market is a device for transferring money from the impatient to the patient." This is the essence of value investing. Patience. Value investing doesn't promise instant riches. Instead, it focuses on finding undervalued assets and holding onto them for long-term growth. This may sound dull compared to chasing a trendy stock, but it's proven to be a winning strategy. Here's a fun fact. Buffett bought Coca-Cola stock in 1988 and held onto it for decades. He didn't expect immediate gains, he simply saw value in the company's steady growth and brand strength. Now, the dividends alone from Coca-Cola bring in over $500 million annually to Berkshire Hathaway. That's the power of long-term thinking. Value investors think years down the road, while many people today can't think past the next quarter. The strategy here? Ignore the noise. When everyone is buzzing about a stock, think twice. Instead of following the crowd, research companies that may not be trending but are strong at their core. Invest in what you understand, as Buffett advises, and focus on quality businesses. Not only does this help avoid the get-rich-quick trap, but it also makes for a more stable, less stressful investment experience. Chapter 2. Financial FOMO. The deadly comparison game. Comparing your financial journey to others is a fast track to failure. Why? Because it often leads to fear of missing out, or FOMO. In a survey, 56% of millennial investors admitted they make impulsive financial decisions out of FOMO. Betterment, 2021. The problem here is that FOMO pushes people into buying hot stocks or sectors without understanding their true value. When a friend brags about doubling their money on some flashy investment, it's easy to feel like you're missing out. The issue? Many of these hot stocks can be volatile and, in the end, lose their shine. Take the dot-com bubble in the early 2000s. People were throwing money at tech stocks, certain they'd make a fortune. When the bubble burst, many lost up to 78% of their investment in the Nasdaq, Federal Reserve Economic Data, 2002. So, what's the value investing strategy here? Know your game and stick to it. In The Intelligent Investor, Benjamin Graham, the father of value investing, writes that successful investing is about being neither right nor wrong because the crowd disagrees with you. You are right because your data and reasoning are right. Instead of comparing yourself to others, set a clear investment plan based on research and sound data. When you focus on your strategy rather than someone else's, you're less likely to fall for financial FOMO. Another smart move is to set up a filter for the news. News stories tend to focus on outliers, not the norm. When you hear about a stock that's going to the moon, take it with a grain of salt. Sticking to a well-researched plan and ignoring short-term trends can help you avoid FOMO and stay focused on long-term wealth. Chapter 3. The Silent Killer, Inflation. fees, and hidden costs. People often underestimate the impact of fees and inflation on their investments. But here's a startling fact. If you invest $10,000 today and it grows by 7% annually, but you're paying 2% in fees, those fees will eat up nearly 40% of your earnings over 30 years. Vanguard Study, 2019. And that doesn't even account for inflation. Inflation can quietly chip away at your gains, especially in a low-interest environment. For value investors, keeping costs low is a core strategy. Many people ignore fees when picking funds or stocks, thinking they're just small percentages. But even a seemingly tiny management fee can make a big difference over time. Imagine this. A 1% fee on a fund that's meant to grow your money might not seem like much, but it can reduce your returns by nearly 20% over a few decades, SEC data. The solution here? Choose low-cost index funds or ETFs for a start. Legendary investor Jack Bogle, founder of Vanguard, popularized this approach, emphasizing the power of compounding without heavy fees dragging down returns. For those who prefer individual stocks, look for companies with low operating costs and stable, long-term prospects. When fees are low and inflation is accounted for, your money has a better chance of growing. A good rule of thumb is to check the expense ratio of any fund you consider. The lower, the better. Also, consider inflation-protected securities or dividend-paying stocks, as these can help hedge against inflation. Another smart tip? Keep trading to a minimum. Frequent trading racks up fees that could be better spent on long-term growth. Value investing isn't about constant buying and selling, it's about holding assets that are fundamentally strong. If you're finding this information helpful, don't forget to subscribe for more insights on value investing and wealth-building strategies. Chapter 4. Patience Pays. The magic of waiting for the right opportunity in today's fast-paced world. Patience isn't just rare, it's almost forgotten. But in value investing, patience is one of your greatest assets. Warren Buffett famously says, "The stock market is designed to transfer money from the impatient to the patient." Most people want quick results, but value investors know that true wealth takes time. A powerful example of patience in action is Buffett's investment in American Express during the 1960s. At the time, American Express faced a major scandal, and its stock price plummeted. While others panicked, Buffett saw value in the brand and bought in, holding the stock as the company rebounded. Today, that investment has grown to be worth billions for Berkshire Hathaway. This shows how patience in the face of fear can pay off. The strategy here? Don't rush. It's easy to feel like you're missing out, especially in bull markets where everyone seems to be winning. But value investors wait for a stock's price to fall below its intrinsic value. This approach is often called waiting for the fat pitch, a baseball analogy. In The Warren Buffett Way, author Robert Hagstrom explains that Buffett waits for the perfect pitch before he swings. This means sometimes sitting on cash and waiting for the right opportunity. A good strategy is to keep a watch list of companies you believe in and wait for them to hit your target price. When you're patient, you're not as vulnerable to market trends or panic. You buy when prices are low, which increases your chances of building wealth. Remember, it's better to buy a great company at a fair price than a fair company at a great price. Chapter 5. The Fear and Greed Cycle. How emotions ruin portfolios. When it comes to investing, emotions are one of the biggest threats to success. In fact, research shows that over 60% of investors make irrational decisions due to emotions like fear and greed. Dalbar, 2021. This fear and greed cycle often leads investors to buy high, out of greed, and sell low, out of fear, which is the exact opposite of what value investing teaches. One famous quote from The Intelligent Investor by Benjamin Graham says, "The investor's chief problem, and even his worst enemy, is likely to be himself." This rings true because our minds are wired to make emotional decisions, not rational ones. Value investing is about using logic over emotion. When a stock price falls, instead of panicking, value investors ask, has the company's intrinsic value changed? If the answer is no, they may even buy more. Here's a strategy to help. Set a clear plan for each investment. Know your reasons for buying, including the company's fundamentals and your price target. Then, decide in advance what would make you sell. By setting these rules, You avoid reacting emotionally to daily market fluctuations. Having a plan lets you ride out market swings without panic. Another tip? Limit how often you check your portfolio. Constant monitoring can lead to unnecessary stress and impulsive decisions. Research from Fidelity found that investors who checked their portfolios daily were more likely to make hasty trades than those who checked less frequently. Value investors avoid this by staying focused on long-term goals, not short-term noise. If you enjoyed this content and want to learn more about mastering value investing, be sure to subscribe. Building wealth takes time and knowledge, and we're here to help you on that journey.